think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show where we think, act, and prosper. Today we got Alan Galecki back on the show. How you doing today?
Hey Darren, I'm fine. Thank you for having me back. I'm really excited to have our next discussion.
Yes. Our last discussion was pre-U.S. election, and we had a landslide of an election in the United States, and the markets just went parabolic. And so I wasn't positioned. I didn't really bet on who would win and what the results would be in stocks in certain companies if that person or that candidate would have won. I was positioned in Tesla, which I have some huge regrets about because I was positioned in early October. I had some call options on Tesla for $300. Tesla at that time was $217. And I didn't let it ride out. I just, it started going down in value. I sold it. And then before you know it, election results come out. Tesla ends up at $322 by the expiration date that I had bought out to. So, I was kind of sad. I was positioned and I didn't hold on to it. I don't know what I was thinking, but yeah, sometimes you win some and lose some.
You went for the safe side. It could have crashed after the election if things have had turned out the other way around.
Yes. It's I think the sad part is whenever the reward outweighs the risk, and so I mean obviously the risk. These call options were $100. When I bought them, they went down to about $60, and so obviously if you put a lot of money up in those call options, then you're risking a lot more. But I think that the reward, those call options ended up being worth about I think $22,100, something like that. So I would have turned $100 to $2,100. So it was like kind of the risk reward aspect of it, where it's like, okay, the reward is more significant than what I'm risking here, like, so that was kind of the sad part for me.
Yeah, absolutely. I feel for you. I'm talking on my publications also about risk and reward everywhere I can, focusing more on the risk side, of course. However, when you have, let's say, a basket of 10 bets with a risk and reward ratio of, I target at least above 2, better above 3 on the reward side. And if you have several of them and only one really goes through the roof, this not only balances out some or a few losses, but the average performance will be really great seen for the entire investment. Hence, this is a very good and very favorable approach. It is, of course, not what mainstream is doing with ETFs, that's for sure. However, if we are stock picking as we are doing, because we do not want to carry around all the garbage that's in indices and in ETFs, because no, they are also concentrated. Many people don't realize or don't want to admit that, but ETFs are highly concentrated, pulled up by only, don't know, 10, 15 really highly capitalized companies, while the rest, if some of them double or triple, you don't even notice performance-wise. And when we are a bit more focused, focus is for me below 20 positions. Yeah, and when you have such a high optionality bet, then of course swings are bigger. This is what mainly is defined as risk. I do not agree to this view. But the reward potentially, if you've done your homework and you avoid all the harakiri bets where it's mainly a coin toss, then it should work out very well over time. But of course, you have to have a strong stomach and to sit one or the other bet out that's maybe temporarily not going in the hoped for direction.
Yeah. And this bet was pure speculation. It's speculating on the election results, and so yeah, which many people did, and they put bets on the S&P, Nasdaq, and they made out pretty well. So what was your take on the Trump trades, and what's your outlook there? Hey everyone, this interview is sponsored by Power Metal Resources. Be sure to click the link in the description below to check out Power Metal Resources, especially if you are bullish on commodities in this current commodity bull run. Power Metal Resources focuses on many different commodities such as uranium, silver, gold, and many others that are needed for the energy transition that we are experiencing across the globe. So be sure to click the link in the description below to check out their company, and you can find them on the London Stock Exchange as well as the OTC market. So be sure to check them out, and let's get back to the interview.
Yeah, the biggest surprise for me, honestly, was that the VIX crashed really brutally hard. It was at 22, 23 pre-election. Tension was a bit high. The month before it was already rising. We didn't have a low VIX, but it was a good chunk above its moving average. I don't know whether it was 100 or 200 days, but it was noticeably above the average. And then with the publication of the results, not even the final ones, only the tendency in which direction it is going. The VIX already crashed to 1615 level. This was a drop of 30%. I must say I cannot remember to have seen such a huge drop. People or the investor base must be really, really highly confident that things will be going out smooth and only up. This is understandable when we compare to the first term of Trump. The first reaction was to the other side, interestingly. It was first down. It was a big surprise because the common narrative was that Hillary Clinton would win. After people realized, okay, Trump won, he is advocating lower taxes and stronger US economy and so forth. Then in a matter of few hours, things turned upside down and the market rallied up. And with the exception of a few dips in 2018, we had phenomenal years, especially 17 and 2019 with a gain of almost 30%, comparably what we've seen so far this year. I fully understand that. The expectations and hopes are that things will turn for better and the stock market will go high. However, then lies also the danger, of course, when everyone sits on the same side of the boat, everyone pretends to know that the direction is only up. This could make up for very interesting times. Yes, we have seen the obvious Trump winners, I'd say. Major banks first and foremost, because of lower taxes. However, this time the picture is a bit different because back then Trump entered into a rising interest rate environment, starting from almost zero. Also, I know the US never had really zero, but it was a smidgen above zero, and then to 2.25 or something like that. Percentage-wise, this is of course a very significant increase. But this time we are on the opposite side, rather to lower interest rates, despite Jerome Powell having said last week that there is no hurry to decrease rates further. But let's see, when the economy maybe won't do as well as expected, then maybe there will be the need to go lower. But I definitely do not expect to see the ultra low interest rates levels again. Maybe to 4%, and that's it. We see that long-term bonds are rising. This is a bit contradictory. to expectations of lower interest rates. Hence, I'd be a bit cautious on this front. Other beneficiaries, of course, were smaller mainly domestically operating companies with little to no exports, of course, because they will benefit even in two ways, not only from lower taxes, but also from a more shielded economy with less competition. And the third group was, of course, defense stocks. However, one of Trump's big promises and campaign points was to end wars. Hence, I'm not so sure how this fits with rising defense stocks. Let's see what will be behind it, but I'm not engaging in this sector anyhow. Hence, this is not of so much interest for me, investment-wise at least. Yes, and then most of them rose by 5 to 10%, and then a last group, a subsector, I'd say, because it is not for the economy, not a big one. Prison stocks, formerly REITs. Today they are C Corps. They converted back, are paying taxes again. However, they had more breathing room for their dividend strategy, and they aimed to lower their debt over time. This is why they converted back. And these stocks, as I've seen, rose 20 to 30% on the same day. This was the biggest jump from a sector that I have noticed post-election.
You said prison stocks?
Pardon?
Did you say prison stocks?
Yeah, sure. Prison stocks. There are two publicly traded prison stocks. One is GEO Group, and the other is CXW is the ticker. It's CoCivic is the name. Yes, CoCivic.
Yeah. I remember GEO Group. I had a friend that worked for them a while ago.
Okay.
And so under Trump's former presidency, and so that was how I got to know them, and I knew the stock had got crashed significantly, but with the talk of like immigration policy and such, I could see that actually jumping up, and I didn't even put the two together until you mentioned it. I'm just going to share screen real quick because I think what you were sharing with the small caps, the small companies, was pretty interesting because I was looking at this move you see on election night, the Russell 2000 ETF was at $219, and then the next day it just gapped up significantly, went up to about $242. It's been coming down significantly ever since then. I'm not sure why, but I can see the reason why these companies and why investors felt like, oh, these companies are going to benefit under Trump. So yeah, it was a huge gap up here, as you can see. I mean, it was over a $10 gap up after the election results was announced, and so that was pretty interesting.
Yeah, definitely. I must confess, I do not have a precise explanation why the gap has almost been closed again. However, some of the bigger stocks also came down again noticeably. There was this interview of Jerome Powell last week where he said that they don't hurry to decrease interest rates, but I cannot say for sure that this was the main event. Let's see. Technicians will argue that open gap has to be closed sooner or later. There will always be reasons found afterwards, but focusing more on the company-specific events and conditions, I do not care that much what is happening with the Russell 2000, I must say. But it is definitely interesting for sure.
And then this is just GEO Group's stock here.
Yeah.
As you can see, I mean it's super overbought. I mean, looking at the relative strength index, it was super overbought. Still is, and as you can see, just a huge. I mean, from $14 to now it's at $26. I'm just gonna pull up a longer term time frame. This was the daily chart. Let's look at the let's see if I look at the monthly.
Oh, wow.
Um, yeah, this is
Roller coaster ride.
yeah. So it hasn't. I think the last time it was at about $34. This was back in 2017.
hmm
So it's been a while since it's been this elevated. But as you can see, I mean, it just popped up like significantly in one day. So I didn't even put the two and two together.
But you know what, Daryl, please don't hide this chart because a few months ago, in yeah, preparation for the election, so to speak, I answered the question on my blog whether prison stocks would benefit under a potential second term of Trump again. My decision was, or my conclusion was no. For now, I'm looking like an idiot saying so. However, if you now show the period of the first presidency, you will notice that in the first reaction, exactly those stocks shot up too, but then they went down for the end of the election and presidency, and even cutting out the lockdown period.
Mm-hmm. Yeah, yeah, for sure. Yeah, so I mean, looking at, I mean, here you got 2016, November 2016, you get a huge spike up here.
Yes.
I mean, not as big as the one that recently, and I think which I don't know, like comparing Trump's first term, if it was as intense, how much they were talking about, like uh, deportation and illegal immigrants and such. And I mean, that was like a big component that was spoken about in this particular candidacy. And so in this campaign, so I mean, as we could see, I mean, it spiked up, until about May of 2017, and then it started to just decline, and it was making lower lows and it continued to decline and decline and decline. I mean, then you got the COVID lockdown. So now,
Yeah.
I mean, this particular spike here, this is just insane, just how much it spiked up in just one day. And so I wonder if that's like how much the campaign was speaking about immigration and such.
Uh, this is definitely the key point. No question about that. But it will be interesting to see how sustainable this is. I do not like to rush after a train that has already left the station, and this looks pretty much to be such a case. Speaking of risk and reward, risk is highly elevated, I would say, for either disappointments or also for valuation wise to come down. And reward, where shall this go when everyone is already expecting the same? Of course, this can over time go a bit higher, but I like the imagination um, for this to be the really great bargain trade where you can only surprise to the upside. This is what I'm looking for.
Yeah, for sure, for sure. Yeah, it's kind of interesting. So what is your view on oil producers now that Trump's in office? He's talked about drill, baby, drill. At one side of it, I'm like, okay, there's a element, you bring more supply online and the supply exceeds demand and the price of oil usually falls. On another side of it, I'm thinking about, okay, is the government going to invest more and be more lenient with oil companies and producers and leases with land and all of those different components, and is that going to help them boost profits or whatnot? And so what's your take on the drill baby drill, and what does this have to do with oil? What is oil going to do?
Yes, this will be the topic of my weekly this week. My view is a bit different from what is commonly expected. Of course, I also see that they will more easily allow for new drillings, for leasings to go easier through, maybe to go for areas that were currently not allowed to be drilled. And the appointment of the energy chief is
is
also
also
a
a
veteran
veteran
from
from
the
the
shale
shale
industry,
industry,
also
also
very
very
interesting.
interesting.
All in
All
all,
in all,
I'm not
I'm not
expecting
expecting
that much
that
of
much of
higher
higher
output
output
volume-wise.
volume-wise.
The
The
reason
reason
being that
being that
conventional energy
conventional energy
production in the
production in
US
the
has been
US has been
declining since the
declining
mid
since the mid
70s.
70s.
This is, of
This is,
course,
of
not
course,
a
not a
growth
growth
story and
story
not a
and not a
recovery to be
recovery to be
expected.
expected.
Then we
Then
have
we have
unconventional
unconventional
shale oil,
shale oil,
also called.
also called.
Um,
Um,
there
there
it is
it
also
is
hard
also
to
hard
see
to see
more
more
growth because
growth
the
because the
most of the
most of the
older
older
fields
fields
have seen
have seen
productivity
productivity
declines,
declines,
and this
and this
means
means
that
that
they
they
are
are
required
required
to
to
invest
invest
more
more
to
to
keep
keep
up
up
with the
with the
production levels,
production
or
levels,
with the
or
same
with the same
investments,
investments,
production is
production is
shrinking and
shrinking and
becoming
becoming
and
and
turning
turning
more
more
from oil
from
into
oil into
gas,
gas,
net gas,
net gas,
and the
and the
Permian Basin,
Permian
the
Basin,
biggest
the
shale
biggest shale
field,
field,
from
from
what
what
is also
is also
about to
about to
turn.
turn.
There's a
There's a
great
great
publication from
publication from
Göring and
Göring and
Rosenzweig. I don't know
Rosenzweig. I
whether
don't
you
know
had
whether you
these
had these
guys on
guys on
your
your
program.
program.
If not,
If not,
then
then
maybe
maybe
you
you
can
can
ask
ask
them
them
because they
because they
have
have
very
very
interesting stuff
interesting
to talk
stuff to talk
about.
about.
If this is
If
true,
this is
what they
true, what
are
they are
calling out for,
out
and in the
for, and
past
in
they
the
have
past
been
they have
right
been right
on a few
on a few
topics,
topics,
then if the
then if the
Permian
Permian
really
really
turns
turns
and
and
reaches
reaches
its
its
plateau
plateau
level,
level,
then
then
it
it
won't
won't
be
be
possible
possible
to
to
increase
increase oil volumes. And this is also further supported. For example, in the last call, the Chevron CEO also said they are preparing for a plateau in the Permian Basin, not growth, not high dynamic and major expansion. It is questionable whether this would be even technically possible, besides a small boom and then a major crash again, because shale fields are more shaky from their performance curve. They shoot up dramatically, but also they come down very fast, and you need to drill more wells and it's a entirely different picture compared to offshore and to conventional oil production. Hence, I'm a bit skeptical about that. And using the precedent from the 70s, where also under, I'm not sure whether it was Carter or Gerald Ford, but they also went for more drilling, more oil. Um, However, they were not able to find more oil
Mm-hmm.
because productivity turned down, and this is something I at least have in the back of my head um, for for this new presidency. And what I'm doing anyhow is that I'm looking outside of the US for growth stories, for organic growth stories in the oil sector, and also with a high share of oil of the entire production.
production.
However, what I'm
What I'm
expecting is
expecting
higher
is higher
valuation
valuation
multiples
multiples
due
due
to
to
more
more
deregulation
deregulation
and
and
less
less
ESG
ESG
chains
chains
and so
and so
forth.
forth.
Hence, it
Hence,
is
it is
absolutely
absolutely
possible that
possible
we
that we
see again,
see
for
again,
example,
for
a company
example, a
like
company
Exxon
like
to trade
Exxon
at
to
a
trade at a
20
20
multiple again.
multiple
This
again.
is
This
a
is a
long
long
time
time
ago
ago
that
that
we've
we've
seen
seen
such a
such a
valuation,
valuation,
but
but
when
when
the
the
investment
investment
environment
environment
becomes
becomes
more
more
friendlier
friendlier
towards
towards
these
these
companies and this
companies and
type
this
of
type of
energy
energy
production, then
production, then
why not?
why
When the
not? When the
major
major
funds and the big
funds and the big
money,
money,
the deep
the
pockets
deep
are
pockets are
allowed
allowed
to
to
more
more
easily
easily
invest and
invest
do
and do
not
not
have
have
to
to
um, excuse
excuse
their
their
investments, then
investments. Then, of course,
this would
this
be
could be
possible that
possible that
despite the lack
despite the
of
lack of
organic growth,
organic
these
growth, these
companies
companies
nonetheless
nonetheless
see
see
higher
higher
multiples
multiples
and
and
thus
thus
also
also
higher
higher
share
share
prices.
prices.
But
But
I
I
do not
do
see
not see
really
really
favorable risk and
favorable
reward
risk
on
and
this
reward on
side.
this side.
It is
It is
rather
rather
questionable whether
questionable whether
Exxon and
Exxon
Chevron
and
could
Chevron
double or
could double or
triple
triple
because they are
because they
already
are
so
already
big,
so big,
especially from the
especially from the
organic
organic
side.
side.
Acquisitions is
Acquisitions is
another
another
topic,
topic,
but
but
um,
um,
it's not
it's
that
not that
lucrative, I'd
lucrative,
say.
I'd say.
We as
We
small
as small
investors, we have the
investors, we have the
optionality
optionality
to go for
to go
smaller
for smaller
companies with
companies with
more
more
interesting
interesting
setups that
setups that
hence I am
I am
passing
passing
on this
on
one.
this one.
Mm-hmm. Got it. Got it. And what's your view on offshore oil producing companies. What's your take on offshore?
Yeah, for sure. This is very interesting. This is an area where I'm active for, don't let me lie, almost 1.5 years. I was not, of course, one of the first, however, ready in time. My view on offshore is a bit different from the mainstream because many people don't know that there are even two sides of offshore energy. What is very well known and covered is the first-time drilling, so to speak, the equipment that is leased by oil majors. Then they drill their wells. If successful, then they start oil production. If not, they drill somewhere else. However, this is the capex side from oil companies or from energy majors, i.e., it is a bit more cyclical and in times of stress can more easily be postponed. And this is also what has hit this sector really hard because these companies roughly a year ago were at rather high levels trading. So their shares were trading at high levels. And one or the other has crashed by 30 to 50% from their highs, despite this being a clear bull market and growth story for this decade, and maybe even one of the very few big growth areas of conventional oil or energy production in general. And the other side that is barely discussed, this is the OpEx side, operating expenditures from energy majors, meaning that they need to do this stuff. Either it is required from the regulator or they simply have no other choice logically. This is, for example, if you have an already operating well and you want to squeeze out more juice of this lemon, then it is, of course, way more cheaper to do so than to drill a completely new one, not knowing for sure whether this will be even a successful project. This optimization of drilling, or also when the oil is upstreamed, then you need to cover that well. You need to how is it in English? Decommission the site. And this is also a task that requires highly specialized gear. And my pick in this regard is Helix Energy Solutions. It is also an offshore company. However, it is, as said, not engaged on the first-time drilling, but all these afterwards special tasks. And it is also or it is very well known among those that followed the leak in the Gulf of Mexico in 2011, the platform from Transocean that exploded, the major leakage. You maybe you have the Deepwater Horizon, was it? Yes, this was the case. And Helix Energy Solutions was the fireman, so to speak, who came to the rescue and stopped closing this leg. Yeah, 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 sure. Yes, and this is my pick. It is also has also come down a bit, of course, because the mood in the sector is not so great at the moment. However, this company is not affected by postponements of projects, and it is currently trading for an expected enterprise value to free cash flow of about 6 for the next year, despite being a sector leader in its niche area. It's very niche and special, of course, but it's has its relevance. And the company is debt-free. Not every competitor is debt-free. This one is, and it is using its strong cash flow generation, which will increase from now on due to expiration of legacy contracts. It is gobbling up some struggling private companies to become bigger itself, however, without increasing the fleet supply. This is also a topic that we need to have on our radar. And this is, yeah, under the radar play that has worked out well so far. Major spike higher, now a correction, but I'm very confident that this will sooner or later resume its upwards trajectory.
Mm-hmm. Got it. Got it. Yeah. Thanks for sharing that outlook. So we wanted to jump back to Zoom. So you've been calling Zoom for a while. I'm just going to share a chart of Zoom. We had did some technical analysis where we had called it at its last earnings. So here's Zoom. As we can see, it was trading around $56 to $58. I remember you came on the show back in August, and Zoom had earnings, and I remember doing the charts and saying like, "Hey, I think Zoom's gonna pop off earnings because it was beaten down so much, and they're I mean, from your valuation, like they're a solid company." And so we had the big pop to $70, and then it came back and consolidated, but it's been running back up. Went almost, it went about to $87 last week, and then now it's back down to 81. But Zoom seems to be breaking out of the slumber that it was in.
Yeah, great recovery story. Speaking of risk and reward, we had, of course, such a software can be replaced sometime. However, there were no indications that this would happen anytime soon. Zoom has its fan base. We both are also using Zoom currently for our recording. And I know many people from the Microsoft fan group. They say, yeah, Zoom is a shitty tool. Excuse my not so well French. But it has a very strong positioning. It's developing further, and what many people don't even know, Zoom is not just a boring video conferencing company. This was the case maybe 2 or 3 years ago. Zoom is developing further. It's becoming a collaboration tool where you have a virtual workplace, so to speak, and where you, for example, have such tools that when you do a recording of your conference, then you can let it transcribe and also sum up the most important bullet points by the tool, and you don't need to do someone that manually anymore. There's many features that can be added over time, and due to expectations being almost non-existent, and the majority has seen this company as being on the deathbed with a beaten down valuation, this was a very, very attractive setup. Some of my members were asking me when the company temporarily was dipping down, whether I'm sure that Zoom is such a great pick and that the stomach starts to turn around. However, I'd said the downside is rather limited. The risk is not to participate to the upside. I said my price target range was around the broader one between 80 and 100, and the more precise one, yeah, around 19 to 100, where I would start to feel a bit uncomfortable again, especially when too many people would start to talk again positively about Zoom. And this is what is happening now. For now, I'm holding. I have this case still active and open. Earnings should come in. I don't know whether this is this or next week, but this was for me a very interesting setup. And now I will wait out the earnings and then make a decision whether to close it, to take the money off the table, or whether to well, if there could be a big surprise, is also possible if growth rates accelerate again, and or on the other side, if buybacks would be increased, because they have several billions in net cash on their balance sheet still, and from quarter to quarter, this number has been growing only despite repurchasing shares. So it is also possible that they increase their buyback program, and the markets, of course, love such announcements.
Mm-hmm. Yeah, for sure. So yeah, I mean, obviously, if you get some really good performance on earnings and stuff, you know, you may want to cash in and take some profits off the table, huh?
Yeah, definitely. We've seen, for example, the competitor Microsoft has not made a new high since summer, since July, I guess. It's struggling a bit, despite being seen as a major growth story, which it is not really, especially not on the buyback side. But with Zoom, less spotlight, less expectations, worse valuation to start from. Hence, the upside or the chances are more on the upside. This was plain and simple thesis.
Mm-hmm. Yeah, got it. That makes total sense. So you recently put out a new piece about Fannie Mae. So, what are you seeing there? What are you seeing there? It was interesting. You sent me the article that you had put
Mhm.
out, and it was interesting. It was like, huh, I never even thought. They don't even come to mind when I think of stocks, right? And so, what were you thinking about with Fannie Mae? Fannie Mae.
Yeah, closing the loop of Trump trades. This was what I very boldly put out as my personal Trump trade. That is not really on the radar of many. Of course, on Twitter there's one or the other expert that has also been writing about it extensively. However, in the broad majority either does not know that such a company exists or would be very surprised to see that such almost dead company, especially when looking at the chart. Yeah, maybe you can show the really long-term chart, the max chart, covering also the financial crisis. This looks really ridiculous to develop interest for such a company. However, for those that don't know, Fannie Mae or in full Federal National Mortgage Association is one of two so-called government-sponsored enterprises that also trade as public companies, and they are both financial services companies with whose task is not to lend money to home purchasers, but they are in the second row, so to speak. They are buying the mortgages from the banks to take to let them give the risks away, so to speak. They are collecting these mortgages, bundling them, and selling them further to international investors. And this is what caused or where the crisis was felt strongly, let's put it this way, in 2008, 2009, because yeah, we know the story. Houses were too expensive. Mortgages were given away almost for free to everyone, to say it a bit exaggerated. And this crashed down, and these companies that yeah, have sold these mortgage-backed securities, they are also responsible for the losses. Many people don't know that, and this is what broke their neck. They were practically bankrupt, insolvent, despite Fannie Mae in the 80s being one of Peter Lynch's favorite stocks. This is also what many people do not know. But the government took them into conservatorship, meaning that Fannie Mae and also its sister company, Freddie Mac, were not allowed to operate freely, do not make own decisions, do not expand anymore, were on stricter capital requirements and so forth. And this is still the case, by the way. However, under President Trump, the thesis and the expectation is that they will be released into full self governance and self-steering again, being fully publicly traded companies, uplisted from the over-the-counter market to the main market again. And interestingly, under Trump's first presidency, the first steps were already taken. However, his time ran out. so that under Biden, where the Democrats said no way, the stock crashed again to low levels, and now with Trump, expectations are back again that they will be finally privatized. There's a letter from Trump to one of the Pauls. I don't know whether it was Rand or Ron Paul from the Republican Party from 2021, where he clearly expressed that he wants to privatize these companies. This is not without specific reason, because these companies have generated tons of earnings in the meantime. They have recovered financially from their stress levels, and they have paid out more in dividends to the government than the rescuing package was worth at that time. And Fannie Mae, in particular, over the last 12 months, has posted net earnings of 17 billion US dollars. And this is the more interesting if you compare to the market cap, to the equity market cap. As at the time of my publication, it was 7 billion, meaning it traded for a PE ratio of 0.4 for a financially sound company that is highly profitable and that has a market leading position in its sector. This was a very ridiculous valuation, explained only by the fact that shareholders, private shareholders, had either had no say in anything, and they were not allowed to receive any dividends because the government exclusively collected them all, which is also, by the way, challenged in courts. But this was not my main thesis, that there would be any type of reversal or payback from the government, which I personally do not expect to occur. However, the government now, by selling Fannie and Freddie, could cash out really big. The number that's around is around 300 to maybe up to 400 billion they could receive cash on hand, which is, of course, very lucrative. Every government needs money, and so far this has worked out pretty well. Of course, there's no final decision. This is still more expectation mode, but on the election day, Fannie Mae, the preferred stock I published my report about, not the common stock, has shot up by 70% on that single day, leaving all the obvious Trump trades way behind them. And then since then it is up by 130% in total, or something in the ballpark. And the good news is that the preferred share still has enough gas in the tank for another double, because as we know, preferred shares usually trade around 25. This is the common stock you are showing, but the preferred share has a par value of 25 and it is trading below 11. And this is a level for highly depressed and stressed companies. But if they proceed and do what is planned and expected, many of his advisors also are, by the way, shareholders or involved in these companies and have a certain interest for this project to get done, and yeah, it's also a rather limited risk, of course, not without risks, but low risk to lucrative upside. And so far, this has worked out very well.
Yeah. I see it. I mean, you got the first presidency of Trump. November. You got a huge spike up between November and February, and obviously came down and spiked back up during his presidency. But here, you put out this article on, I think the price was around $3 and some change per share, or $4 per share. It says that you put it out on October 3rd. And so, and then you obviously doubled your money, over doubled your money,
Yeah, more than that in a month.
Yeah, for sure. So, what's your outlook moving forward? So you mentioned that the risk is low. Do you think this is still a fair pricing environment in terms of the valuation of the company and such?
I must stress again, it is the preferred share, the Series S. Yes, this is this one that you're showing, and not the common one, because the common has a dilution risk. The government has has a warrant running until the end of the next term, where they can, if exercised, get their hand on 80% of voting rights, i.e., common shares, and they currently have, I don't know whether it is even 5%. Meaning this is a huge risk for dilution, which I cannot fully do a calculation, and it is a factor of high insecurity, of course. People becoming more and more aware of the story will rush for the common stock because it is way more liquid, of course, and it is thinking straight. The first thing that you do is buy the common stock and not think of potential risk and special situations and going for other choices. Hence, I expect in the short term the common stock shall also run massively higher. We have this is the common. We are at yes 10. I can easily imagine 15, 16 in the short term until inauguration. But then we'll need to see what will be announced. I'm personally also here with a smaller position involved in the common stock. However, I think I will close it rather sooner than later, and focus on the preferred Series S, because when there will be a restructuring or a reorganization and privatization, or however you want to call it, it is a predefined value of 25 that needs to be paid to the shareholders of preferred stock, and there is no dilution risk. Hence, I prefer to maybe give up some of the potential upside. However, I'm also giving away a major risk, which is the dilution factor. And if the preferred stock won't be bought out and they reinstate their dividend again, this is another possibility of what could happen. Then in relation to the price when my report came out, this would be a dividend yield of almost 50% on an annual basis. 15, not 15, half of the buying price. This is also not common to see on the markets, and that's why I love such underlooked and special situation cases where I do not have to worry so much about whether the market has run hot or whether a gap has been closed, or whether one or the other rumor emerges, as long as this specific case is as solid as it has been on day one. And this is the case here. Hence, this is currently also my single best idea. I must add to that. Yeah, happy to watch it develop. It's of course a bit more volatile because the volumes have shot up dramatically, and more and more people are getting aware of this opportunity. But yeah, why not? This is a case that you find maybe one or the other year, every 2 or 3 or 4 years. Do you find such a very lucrative underlooked setup? And this is where I was from the beginning highly convinced. Yes, this reads very, very well, very promising. Where's the risk? And the only risk I could find was basically that the election would result in a democratic win. Of course, this was in a certain way also a gamble on the election outcome. However, speaking more with ordinary people and not listening too much to media, the odds were more on the Republican side, if we are honest. And also this campaign with Trump running in the garbage truck, brilliant from those who instigated that. yeah, this will be remembered forever. I hope this trade will be remembered forever too.
Coming on and everything, you all, Alan's giving you multiple trades as he's been on the show multiple times and everything. So I always appreciate you sharing that with us. Where can people find more about the work you're doing, the reports you're putting out, the ideas, trade ideas you're giving out?
Yeah, thanks for asking, Daryl. Everyone who is interested in stock picking and focused investing and in individual ideas is welcome to visit my website, financial-engineering.net, a blog where I'm writing about such topics, about a bit of investment philosophy and strategy, portfolio strategy, but my topic of heart, so to speak, is stock analysis, and I'm looking for ideas that have very lucrative setups from the risk and reward side with the goal to finally beat the indices.
Yes. Well, appreciate you for coming on and sharing that with us and everything. And I'll be sure to link to that in the description below. And thank you for coming on.
Thanks a lot, Daryl. Thank you for being on your program, and happy to come back soon if you want to.
Yes, indeed. We'll have you back.